This space was downloaded via spacesdown.com. Visit to download your spaces today.
All right. While we're waiting for World War III to start, can everybody hear me? Well, I hope so. Um, while we're waiting for World War III to start, I figured we do just a quick. I haven't done one of these spaces in a while, so I figured we talk a little AGL. We've put 2 notes out on our Substack. Really encourage people to go there. Really appreciate everybody who subscribes. It's really been a great experience for me so far. Before we jump in, just a little disclaimer. This is for discussion purposes only. Nothing should be considered investment advice. Some or all of the securities we're about to discuss may or may not be suitable for you. Please consult an investment advisor before making any investment decision. Investing in the stock market contains a series of risks, including and especially the risk of loss. This is a highly speculative security, stock, asset, what have you, and it's probably not for most people. And so forth. So please refer to all the notes. This is going to be an abbreviated version. Please read the disclaimers and the risk disclosures within all those notes. So AGL, this thing just very simply is one of those things in the bucket of stocks that you come across that you look at and you're like, wow, this could be between a 5 and 25 bagger. We said 5 and 15 bagger, but you can look at the stock chart since the IPO. It went public at an $11 billion valuation. And, today it's trading at under, about 300 million bucks, which is kind of nuts. They just did a 25-for-1 reverse split. The thing peaked out at over $1,000 per share, split adjusted. We bottomed at $8 a share, and now we're about 16, about a week after the reverse split. This thing has a ton of revenue. It's got revenue peaked at about $6 billion. It's guided to be about 5.5 billion this year, about 330 million of medical margin. And again, I'm going to talk about this thing at $20 a share. It's 16 right now, but I'll just use round numbers. 5.5 billion of revenue. You're paying $360 million for this business. Like, if this thing is anything, you can make a ton of money. The market is pricing this thing at less than zero. It's pricing it as expecting to go bankrupt. EBITDA has been negative for several years. They were making money until 2023, and then value-based care fell off a cliff, and these guys started just losing a ton of money. The guide for next year, I should say this year, 2026, is 330 million of medical margin and zero of EBITDA. They think they're going to be free cash flow positive next year. You come into this year with 375 million bucks of cash. They're projecting they're going to end the year with 125 million. You say, okay, the EBITDA guide zero, you only have 40 million of debt. What's going on? Why are you losing 250 million bucks of cash by year end? That delta is prior year development. So those are mostly losses that they've already experienced that they haven't billed for or that they expect going forward. And then in 2027, again, they think they're going to be free cash flow positive. A few things that caught our eye and why we looked at this. And again, we covered this space from the IPO. We did terrible in Kano. We did terrible. Well, actually, we did fine in Kano. The stock did terrible, but we got out. Caramax, we got murdered in. TOI has been a nice home run. Privia, we've made money. Um, but generally, this has been a disappointing space. Two things that caught our eye recently. Number one, I mean, other than the stock price just precipitously falling. On 3/3, so about a month ago, there was an insider buy at split adjusted $15 per share. It was 60 cents pre-split from the chief markets officer. It was several $100,000. And if you remember, those who've read our TOI work, at the bottom you had a random, well, not an unrandom board member, the former CEO, who bought literally at the bottom before that thing turned. So you spend a couple $100,000 of your money. That kind of, catches our eye. Secondarily, late February, they announced a 2-year amendment and extension of their debt. Now, this doesn't have a lot of debt, but just the process, and it's got 40 million bucks of debt, so nothing. But having to go to committee and whatnot, I mean, those lenders had no reason to extend, and they must have gotten comfortable that the transition, if you will, was going on. And it's sort of a nice proof point if you want to believe management guidance. So, you had those two little data points. Lastly, you had the 25-for-1 reverse split. Now, reverse splits are absolutely terrible, especially a 25-for-1. You're not doing a 25-for-1 if things have gone well. What we've seen occasionally, and I would point at WGS, which is a genome exome company that had about a 3-year turnaround and finally bottomed similarly when they did a massive reverse split. What that does, because the stock price got so low, I mean, right the day before the reverse split, AGL was trading at 32 cents. You just knock out all of these people that are like, I get this off my desk, get this off the sheets, I don't care. So you saw, if you go back to the volume, the last 5 days of March, you really saw a huge flush and a clearing event. And the stock got to a level that was just absolutely ridiculous on 3/30, so second to last day of the quarter, or maybe it was 3/29. AGL was off. I mean, traded down from 42 cents to 32 cents. Now, the guy's selling down 20% in a day on basically, it was bad war headlines, and it was just more acceleration of people dumping. And so the reverse split created this entry point. Now, whether that's a good entry point or not is sort of the question. The stock's already rallied about 100% off that pre-split low. But that was sort of our big picture thesis. The other things that we liked about this setup, Medicare Advantage and all the names like UNH and Humana have been eviscerated this year and really have been weak all last year as well. The space over earned. We put the charts in from Humana in our last note. It really over earned coming out of COVID because nobody went to the hospital. So MLRs were really good. And then you finally had a rate catch up a few years later. But all this stuff got torched. And this year, especially, you saw starting in the JP Morgan Healthcare Conference 2 weeks into January, from that moment on into the Medicare Advantage rate notice, which was basically a 0% rate increase that was announced about 2 months ago overnight. And part of the reason AGL is up today with the whole space is that the final rate notice was less bad. You got about a 2.5% rate increase. But just big picture, what we'd say is the biggest names in this sector, United, Humana, Evolence, whatnot, everybody who touches Medicare Advantage has been torched. Go further to the value-based care names, specifically the value-based primary care names, which is, what this thing touches. They almost all went bankrupt. Kano, we've talked about it, went under. Caramax went under. Oak Street Health got bought out by CVS, but that's been a disaster since. One Medical bought by Amazon. They don't talk about it anymore. AGL, this stock has just been torched. Really only Privia survived, and there's a few other ones that are sort of value-based carry, as well, like Alignment ALHC. You've got Clover, but this whole space has just been brutalized. And when we really go back, like one of the, our takeaways from Kano and CareMax was sort of this founding principle that the payers, United, Humana, Elevance, were keeping 15% of the total Medicare Advantage premium, where the value-based primary care guys were keeping 85. So 85-15 split. Now the value-based care guys were absorbing 100% of the MLR risk. So it was great for the payers, United and Humana. Great, you're taking no MLR risk, you get 15% of the premium. And you saw this sort of misalignment play out in that United, Humana, Elevance all really ramped up the benefits they gave to get members. Now, one of the things that we called out specifically in our note, and we've called it out before, is at one point, these guys were doing these flex cards for new members where they were just paying you $200 to $300 a month to be a member of your health insurance plan. Now, why did Humana and UNH do that? Because they're only paying 15% of the cost of those things, and they're just dropping those losses onto the value-based primary care guys. And so, that plus obviously the MLR and the rates, all these guys sort of went under. What we've seen recently is this transition. And we did a note on Elevance, Evolent, EVH, which is a oncology value-based care name. Earlier this year, and that's up a bunch today too. And I mean, it's super interesting at $250 a share, 6x levered, company that trades at 8x. We think it got duration, whatnot. Anyway, that's one where they woke up on the earnings call this year and they said, look, we restruck all of our agreements. We went to all of our partners and we said, the current agreements in terms of the split of risk and how much money we're making makes no sense for us, and we are going bankrupt. Our stock's gone from 35 to 2. We are done if you don't give us relief. And so the guys they contract with, the biggest being Cook County Hospital in Chicago, said, no, 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 you provide us value. We're going to restrike the agreement. We're going to pay you if you can beat a 103 MLR.
This space was downloaded via spacesdown.com. Visit to download your spaces today.
Let's go to AGL and why I'm giving you this little background. One of the things specifically that AGL has been just torched on over the last few years is Medicare Part D, which is drugs, pharmacy. They have no control over that, and they're just bleeding losses. And so what they've said this year is, on the last 2 or 3 calls, and they fired the CEO mid last year after another guide down. But the new guy who's an executive chairman said is, look, we went back to everybody and we went point by point. We said, look, this 85-15 split makes no sense. Why are we taking risk on Part D? You, Humana, you, United Healthcare, you guys know what you're doing there. The value that AGL provides is we partner with the primary care physician groups, okay? And we give them scale on all the third-party spend and specialists that they need to contract with, because under value-based care, effectively the primary care guy becomes the insurance company, has to coordinate everything. Okay. So AGL is going to the insurance company who collects the payments and the primary care guy, and they're saying, look, the primary care guy handles primary care. The insurance company handles the admin and all the payment stuff and all that. All right. We are going to coordinate with the primary care guy on getting you the best rates at hospitals, the best rates with specialists, and all this other stuff. Why are we bleeding money on Part D? That's not within our stuff. Okay. And so let me just make this very simple to sort of elucidate this point. Okay. AGL currently has 500, well, it's projected to have 530,000 members at the end of next year. Currently, they're at 625. They peaked at 660. They've already been shedding members that have been unprofitable. Let's just use the 530, okay? What AGL is basically saying to their payer partners and to the market is, we're doing a lot of stuff. So what is the right economic return that we're supposed to get? Say that if you believe, let's just use a low number. The typical Medicare Advantage total premium dollars is, $1,250 to $1,500 PMPM. That's per member per month payment. Okay. Figure a 10 to 15% profit margin. So you're playing for, in total, there's let's just call it $200 to $250 of profit PMPM that you have to split. The market needs to split between the payer, United Healthcare, Humana, Elevance, whoever, the primary care guy, all the specialists, and what AGL does, which is taking that value-based shock absorber, which is if MLR is higher, they're going to eat it, but they're going to try to get costs lower than trend. Okay. What should AGL get of that? Should they get 10%? Well, 10% would be $25 PMPM. So if you take 530,000 members, $12 months, $25, that's 160 million bucks of EBITDA. Again, on something that at 20 is, you're paying 360 million bucks for. So 2 times EBITDA. If you think they can get 50, obviously it's 320 and whatnot. And so we laid out, okay, in our note, and just to frame how cheap this is, at $50, you're talking 900 million bucks of TV, assuming the cash is zero. Like, it's just not that expensive at all. And obviously at $100, it's 1.8 billion. And again, it went public at an $11 billion valuation, and they've got 5.5 billion of revenue. So the potential, if the turnaround works, is real. You're already seeing the data points of the payers pulling back on benefits and finding a way to compensate the value-based care guys appropriately, or give them something so they don't go bankrupt. And so that's kind of the hope. The other piece that we sort of laid out is sort of this idea that within the 5.5 billion of revenue, and again, like, this is how fast this thing has ramped, which is just crazy. This thing was doing in 2019, $800 million of revenue. By 2024, $6 billion. That's how quickly this ramped. And what they do is, this is AGL, they go physician group by physician group, get scale in local markets, state by state. And so what we think you can do, the longer that, the longer you're in state, the bigger the impact AGL has. There's a J curve with that growth, because you're going to lose money the first 2 years. But if you've been working with a primary care group for more than 2 years, you're going to make a bunch of money. And so what AGL's already started to do, and we think accelerates, is you're going to take the 6 billion peak revenue in 2024, and you're going to just go group by group with the insurance company and just say, look, if you're not going to make it profitable for me, I'm happy to walk away from this business, which is what they've done. And they don't need national scale. They just need scale in market. So we think there's this core of 2.5, 3 billion, maybe 3.5 billion. If the insurance companies don't work with you, that is profitable. Now, what we're seeing, though, is they're like, look, no, we're still going to grow a little bit. We're going to walk from some contracts. The insurance companies are working with you. And that's how you get this Super Bowl case of maybe you keep this thing at 5.5 to 6 or $7 billion, and you just grow and you earn a 10, 15% margin on that revenue. And all of a sudden you're at 750 million of EBITDA. You really don't have CapEx. Maybe you normalize 500, 600, you put a multiple on that, and you're like, holy cow, this thing could be hundreds of dollars if this thing turns around. So you have this, I'm not going to say leverage. You're putting the payers to this decision, and the primary care partners a little bit to this decision of, I'm walking, I deliver value, it's going to go away, and I would like to see that. So are we seeing proof points for this thing? Yes, we are. First off, they've already started walking away from business, and you've seen that over the last 2 years. Secondarily, they are getting in 2026, and this is really the near-term question, which is, we make a lot of money from here if the guide is correct. They blew the guide in 2023, 2024, 2025. I mean, they blew it epically. Let's just start at 2025 for a second to understand how bad they blew the guide. Last year, 2 years into the stock blowing up, they guided to $300 million of medical margin and negative 75 million of EBITDA. This is in February, okay? They actually did negative 57 and negative 300 million. So from 300 million of medical margin guide in February, they missed so bad. They missed by 360 million and lost money. On EBITDA, they thought they were going to lose 75. They actually lost 300 million bucks. Just crazy. Now, they've stepped up, and this has been one of the other issues. They've had limited claims visibility, so they didn't know how much money they were losing or making. They weren't really making money, but it could have gone the other way. They've really ramped up the monitoring and the real-time access and whatnot. With the guide as well, the other thing they did, why we think it's sandbagged, they guided presuming a 7.5% annual cost inflation. They've never had more than 6.5%, and they've already called out the Part D stuff. They've done a lot of stuff to really clean this out. So we just think it's likely that they kitchen sink the guide and they're not going to miss. If we're wrong on that, it's just over, because they're going to run out of money. Or the market's going to presume a dilutive offering and what have you. But if you're right on that, this thing, and the next earnings is going to be big, and the earnings after that is going to be big. This thing with nothing changing is probably somewhere between 50 and $75 a share by the end of the year, just by hitting the guide. Again, the stock is 15, $16 right now. It's nothing. You don't have to answer all these long-term questions, which is kind of, to us, it's pretty fascinating. The last piece of this thing, that just to call out, CD&R, the private equity firm that took this thing public, still owns 24%. Morgan Stanley owns 12%. A hedge fund called North Peak owns 9.5%. So you have the top three guys own 45%. They are aligned. They have a reason to see this work. The index funds still own 7-8% of this thing. And yes, it is still in the R2K, the Russell 2000. And at this share price level, I mean, the CD&R shares don't count. You probably need to get to $25 a share to make sure that you stay in the Russell. Or sorry, CD&R and Morgan Stanley is over 10%. They would both be excluded. So you need to be about 160, 170 million bucks of market cap. That's not excluded to stay in the Russell. But there is this self-fulfilling thing that, like, the higher this goes, the more likely they are to stay in the Russell. Certainly, a week ago, it looked incredibly certain that the index funds were going to come out. If this thing stays and the small cap guys get conviction that it is, you're going to see a lot of guys show up, and so forth. The other thing that could be positive as well is if this thing does normalize at 50 bucks, like we kind of think it can over the next 2 or 3 quarters. You got 18 million shares. If you do another 10, I mean, you don't even need to do another 10. You do, I mean, you do it at 40 bucks, you do 5 million shares, it's 200 million. You buy yourself so much duration and market comfort, and you just self-correct the balance sheet. So there is this like pro-cyclical nature, obviously. I mean, it's a really discounted stock. I said last point, but I'll just make one just to emphasize again. I think when we published 2 notes on this thing, the biggest piece of feedback has been, is the revenue really $5.5 to $6 billion? Like, it's crazy. I can't remember a situation like this, where you just have so much. And we highlighted that as a asset in terms of you can shrink and cash flow this thing out, and there's a profitable core. The other piece that sort of goes less spoken is, for a company of this market cap, I mean, again, you're paying, at 20 bucks, you're paying 360 million bucks for this, assuming the cash is zero. You're just getting a higher business quality. Like, CD&R is a really good private equity firm. Obviously, like, they'd be much happier if the stock wasn't here, although they've monetized a lot of their investment. I'm sure they did really well. But you have, like, what I'll call a real business. Yes, they don't have a CEO right now. The executive chairman stepped in. That's probably another catalyst, which is if the stock can sort of normalize here, you're going to get a real guy to run this. The exit very well may be just a takeout by a payer like Humana or somebody else who wants the platform. If that's the case, you're going to get a multiple of medical margin as opposed to EBITDA. But there's just a lot of optionality and duration. And that's sort of the big thing that we look for in these asymmetric sort of distress situations, which is, if you get duration and you get hope, man, a lot of things can happen. So it's a really interesting name. We covered a lot of ground. Again, we've got 2 notes out on this. We hope people take a look and read them. I think the setup's really good. And again, like, on the downside, look, we could just be wrong. They could just implode and die. But look, we sort of hang our hat, at least in the near term, on the insider buy and the credit amendment. So anyway, happy to chat with anybody. If you want to reach out on Substack or Twitter on this name, we think it's interesting. We think it's something to do. So please read the notes, read all the disclaimers, and really appreciate everybody listening.
This space was downloaded via spacesdown.com. Visit to download your spaces today.